All right, another wild week for the bond market and for mortgage rates. I mean, it's no surprise headed into this week that the markets had Friday circled on their calendar, right? This is the NFP, non-farm payroll, the employment situation report. Now, Friday's data was especially important considering what happened the last report on February 3rd, which basically served as the catalyst for that wild spike in rates basically through February into March, taking mortgage rates to their highest levels in months. Now, before we got to Friday, Jerome Powell spoke at a two-day congressional testimony, Tuesday and Wednesday, where he gave his semi-annual monetary policy report. And in providing this report, he was very concerned and spoke of the potential of taking their short-term benchmark rate much higher than had previously been forecasted. All that in response to incoming data pointing to a very resilient economy. Now, these comments forced the markets to reevaluate their own rate outlook, which directly impacts mortgage rates. So as a result, Tuesday and Wednesday, mortgage rates rose their highest levels going back to early November. Now, Thursday, we did get some relief in the form of jobless claims and continued claims coming in higher than expected. So we did close the day in the green, definitely a welcome sight headed into Friday's employment data. Now, Friday morning, as we approached the 8:30 a.m. reading, MBSs and Treasuries were already heavily in the green. Now, why is this? Global markets were already reacting to the uncertainties surrounding Silicon Valley Bank's implosion. Rattled the global markets, basically a huge flight to safety. This is when investors take their money out of risky investments like stocks and instead prefer the safe, stable rate of return via bonds. Now, the jobs number is definitely aiding that momentum. Payroll growth came in unfortunately higher than expected, but unemployment went up and wage growth came down. That's exactly what the Fed wants to see. They want to see wage growth tighten. These two factors combined to push rates on the biggest single day rally in 4 months. Definitely a welcome sight. Now, next week's going to bring us CPI. This is going to be a big one, Consumer Price Index, right? This is the market's favorite with regards to inflation. If this data shows that inflation is coming down month over month and year over year, expect for rates to continue to improve. Also keep an eye on how the Federal Reserve is going to respond to the ongoing criticism surrounding SVB's collapse. Now, mortgage rates coming down, pockets of inventory coming up. I mean, this is definitely an exciting time across our housing market. You have any questions about these headlines, about these recent rate trends, or if you're ready to discuss your pre-approval options? Let's talk.